Let's take a look at performance evaluation in decentralized organizations. First, we need to have an understanding of what we mean by decentralization. In a decentralized organization, decision-making occurs at all levels of management, from the lowest level manager all the way up to the top. Companies are not either centralized or decentralized. They're going to fall somewhere along the continuum. And this could change over time as the company changes and grows. There are distinct advantages of decentralization. Managers with first-hand knowledge of the day-to-day operations will be making the decisions, so they have more knowledge. It provides management training. It does free upper management up to focus on those strategic decisions. And it's a motivation tool for managers. And finally, it allows for faster response to change. The disadvantages of decentralization include that it can lead to duplication of assets and services. You may have to have more of your service departments at various locations, and sometimes your different divisions will be doing the same activities, and that can be costly. Goal congruence can be an issue. When we say goal congruence, we are talking about the alignment of the manager's goals with the company's goals, and we'll talk more about this later. It can lead to a lack of coordination. This is all in the context of what we call responsibility accounting. In a responsibility accounting system, you're going to accumulate and report costs and revenues on the basis of the manager, who has the authority to make decisions that influence the level of those costs and revenues. You'll need to break your organization into responsibility centers, and these are just going to be centers that are responsible for the decisions made. And then we'll prepare a performance report for these managers. There are three major types of responsibility centers. A cost center manager can influence only their costs. These are your lower level managers or your production manager. Service department managers such as accounting, human resources, and IT. They typically do not have to generate a specific level of revenues. They only need to control the costs. Profit center managers can influence both revenues and costs of their segment. This might be a sales department manager or division manager. Investment centers, here the manager can influence revenues, costs, and the allocation of resources. So this manager decides which assets to buy, how to distribute them among the various segments of the business. So this will be your upper level managers. Could be a division manager. If you operate in a very decentralized format, you will allow division managers to make decisions about assets and how they're allocated. For example, the CEO of PepsiCo. This manager is going to have to decide how to allocate among soft drink sales, Frito-Lay, and Tropicana, their divisions. Now, it's important to classify your responsibility centers because how you evaluate them will be influenced by that. For a cost center, you're going to compare actual cost incurred to flexible budget costs. We will work a problem on this soon. Profit centers, you're going to compare actual profits to flexible budget profits. That is both revenues and costs. Okay, now notice that both of these you compare actual results to the flexible budget, not the static budget. We have actually already seen a profit center performance report. In a prior chapter, we worked Samaritan Medical Clinic example, and that is a profit center report. Investment centers, we're going to evaluate based on income, but also consider the investment that was available to this manager. And this will be the focus of our next segment.